Breaking news. Global housing bubble at risk of popping. Headlines flash across screens worldwide, from London to Sydney, as tension fills the air. Imagine a young couple finally ready to buy their first home, now hesitating as prices drop and agents lose confidence. This scene is repeating everywhere. The era of endlessly rising house prices may be ending. The mood has shifted. The fear of missing out has become the fear of overpaying. Buyers worry about losing value. Homeowners watch their equity shrink. The foundation of the housing market, confidence and growth, shows cracks. This isn't just about numbers, it's about the dream of home ownership. For many millennials and Gen Z, falling prices bring hope, but also economic dread. A housing crash could trigger recession and job losses. The world is watching, holding its breath. Is this a gentle cooling or the start of a painful downturn? Real estate sites fill with price reductions. Economists debate how deep this slide will go. The great housing shakeup is just beginning. Whether buying, selling, or just trying to stay afloat, everyone is affected. The next chapter will shape the future for families and economies alike. The story is no longer about how high prices can go, but how far they might fall. The global housing market stands at a crossroads.
The housing market's troubles are no accident. They're the result of a toxic economic mix. First, high inflation. Everyday costs are up, eroding savings and making homeownership harder. Second, rising interest rates. Mortgages were once cheap, fueling price surges. Now, central banks are hiking rates to fight inflation, making borrowing far more expensive. Third, weak economic growth. Job insecurity and recession fears keep buyers on the sidelines. These forces combine to create a perfect storm. Inflation eats away at down payments and confidence. Higher rates shrink what buyers can afford. Economic fear makes people hesitate to take on big debts. The result? Demand drops, prices fall, and uncertainty grows. The red-hot market has cooled into nervous apprehension. The party of easy money is over. Buyers and sellers alike are left wondering what comes next. The housing market is now a battleground for economic forces beyond anyone's control. Every decision, buy, sell, or wait, feels riskier than ever. The market's fate is tied to inflation, interest rates, and the broader economy. The next moves by central banks will determine how deep the correction goes. For now, the only certainty is uncertainty. The housing market's future hangs in the balance. Central banks fight inflation by raising interest rates, but the housing market often pays the price. Higher rates make mortgages more expensive, shrinking what buyers can afford. A small rate hike can add hundreds to monthly payments, pushing homes out of reach. Buyers are forced to look for cheaper homes or give up entirely. As demand drops, sellers lower prices to attract buyers. The housing market becomes collateral damage in the war on inflation. Central bankers know their actions cause pain, but see it as necessary to avoid worse outcomes. Unchecked inflation can devastate economies. A housing correction, while painful, is the lesser evil. The hope is for a soft landing, a gentle cooling, not a crash. But the risk of a hard landing is real. Every rate hike tightens the squeeze on buyers and homeowners. The balance is delicate, and the stakes are high. The housing market's fate is now tied to central bank decisions. The next move could tip the scales toward recovery or deeper trouble. In the UK, home ownership is a national obsession, now facing a harsh reality. The Bank of England's rate hikes have sent mortgage rates soaring, slamming the brakes on buyer demand. Data from lenders shows a clear slowdown, price growth has stalled, and monthly declines are now routine. Sellers are forced to offer discounts, buyers negotiate cautiously. The psychological impact is profound. Negative equity looms for recent buyers, and affordability is at its worst in generations. First-time buyers face high prices and crippling mortgage rates. The government's options are limited, as intervention could fuel more inflation. The market is gridlocked. Sellers hesitate to list, buyers hesitate to commit. Analysts debate whether this is a modest correction or the start of a deeper downturn. The nation waits, uncertain and anxious. The UK housing market stands at a crossroads with no easy answers in sight. Understanding housing data is key. Slowing price growth means prices are still rising, just more slowly. Falling prices means actual declines. Homes lose value month after month. This shift from slow growth to outright drops marks a critical turning point. For homeowners, falling prices shrink equity and spark panic selling. For buyers, falling prices are tempting but risky. No one wants to buy before the bottom. many markets are now moving from slow growth to real declines. Monthly data turning negative signals a true correction. Analysts watch these numbers closely for signs of deeper trouble. A few months of declines could be a blip, but sustained drops confirm a downturn. The distinction between slowing growth and falling prices is crucial. It shapes decisions for buyers, sellers, and policymakers alike. The numbers tell the real story behind the headlines. The U.S. housing market, once supercharged by low rates and pandemic demand, is cooling fast. The Federal Reserve's aggressive rate hikes have doubled mortgage rates, shocking the system. Home price growth has slowed sharply. Sellers are cutting prices, especially in former hot spots like Austin and Boise. Affordability is at its worst in decades. Monthly payments have soared, pushing many buyers out. Renters feel the squeeze too, as demand for rentals rises. Inventory is up but still low by historical standards, which may prevent a full-blown crash. The market is correcting, but supply constraints could provide a floor. The dynamics are different from 2008, but uncertainty remains. Buyers, sellers, and renters all face tough choices. The next moves by the Fed will shape the market's future. For now, the U.S. housing market is in a state of uneasy transition. The chill is real, and the outcome is far from certain. Australia's housing market soared for years, but the boom is over. The Reserve Bank's rapid rate hikes hit hard, especially for homeowners with variable rate mortgages. Monthly payments jumped, crushing confidence and borrowing power. Prices in Sydney and Melbourne are falling fast. The downturn is sharper than many expected. Auction clearance rates have plunged, and fear of overpaying has replaced FOMO. Major banks predict peak-to-trough declines of 15–20% or more. With household debt among the world's highest, the risks are serious. A big price drop could hit the broader economy and financial stability. Regional markets are cooling too, not just the big cities. Australians watch the RBA and property data with anxiety. The correction is underway, but the bottom is unclear. The nation braces for what comes next. Canada's housing market, once among the world's hottest, is now in a deep freeze. The Bank of Canada's rate hikes have hit hard, with home sales and prices falling sharply. Bidding wars are gone. Sellers accept lower offers as homes linger on the market. Many homeowners face payment shocks as variable and renewing mortgages reset at higher rates. Over-leveraged households may be forced to sell, adding supply to a weakening market. The downturn is sharpest in markets that boomed during the pandemic, especially in Ontario and British Columbia. More affordable regions are holding up better, but the national trend is down. The Bank of Canada's focus remains on inflation, not housing pain. The freeze is likely to last, with uncertainty for buyers and sellers alike. The psychological shift is as important as the numbers. Canadians are bracing for more turbulence ahead. The market's red-hot days are over, for now. Across the globe, the era of cheap money is over, and housing markets are feeling the pain. Central banks are raising rates to fight inflation, and prices are falling or stagnating nearly everywhere. The speed and severity of the downturn vary, but the pattern is clear. Markets with high debt and variable rate mortgages like Australia and Canada are most vulnerable. The US is somewhat shielded by fixed-rate loans, but new buyers face steep costs. A lack of supply may prevent a 2008-style crash, but uncertainty dominates. The future depends on inflation and central bank decisions. If rates stay high, the downturn could deepen. If inflation falls, relief may come. Buyers and sellers are stuck in a standoff, waiting for clarity. The next 12 to 18 months will shape the housing landscape for years. The world is watching to see if this correction ends gently or with a crash.